Hello student, welcome back to IBS. Today we are going to learn about statement of comprehensive income overview part 1. Statement of comprehensive income is also one of the financial statement which is very important to know, because whatever the thing which we cannot able to update in income statement or we cannot able to realize in income statement, those things will come into OCI and their changes will impact to our equity section. We cannot keep it into either liability section. That is why we will do the changes, or whatever the updates is will come into your equity section. So let's jump and understand the definition. What are the item will come into this? So as I have represented here, as you can see, there is an income statement of a company. In that there is sales, revenue, then they will have total expenses, then they will have operating, then they have interest expense, and then they have tax. After tax they are having their net income. So this is their net income, but as per statement of comprehensive income, their total income is 2005k, not 2000. Why? Because as you can see, there is other comprehensive income. OCI has two items. Normally in OCI there are 5 line items mainly, so there are 5 different concepts. Based on that, anything will come into that will come into your statement of comprehensive income, so that we will discuss later. But there is two important point they have mentioned. Unrealized gain on AFS or available for sales security. If you have any in unrealized gain for AFS, suppose you have purchased this into 1000k, and at the end of the particular period, that time your asset has some value, either it is becoming 120 or maybe it will be 90k. So if it is more than your purchase and fair value the time when you have purchased, and the current value is higher than that, so that 20k will come into as a positive. That will increase your net income, and their impact will also go to your equity section of balance sheet. In equity section we have share, common share, additional paid in capital, and then we have retained earning. So this income part will go to your return earning. Whenever you will gain, so that will be added. Whenever you will loss, that will be reduced. Similar way, there is one more line item which is called accumulated comprehensive income. So statement of comprehensive income or related to like how return earning is working, similar way accumulated comprehensive income will also work. So whenever you will like this difference between these, whatever the difference will come, overall difference will be charged here. So there if you can see, they have a total increment, then increment will go into your OCI, then your equity value will increase. If you have any loss or something, then your equity value will go down. So similar way, how your return earning is working, similar way it will also work. I hope it is clear to you. So let's read it out. Net income, this is the same thing I think I have already explained. Where do we see our statement of cash flow? As you can see, we can see just right next to the income statement. Now we will learn about the basic definition of statement of comprehensive income. Includes all changes of company equity, whatever the changes is happening between two period, during the period or between two period from 1st Jan to 31st December. Between these two periods, whatever changes has happened will come here, resulting from the transaction from owner. Like if you are issuing and you are repurchasing, you are issuing share, all those things will come here. It is a broader than net income, because net income will end after the tax. After tax we have some non-operating net income, whatever amount is. Then after we have other non-operational business related stuff will come. Then after, once you have your final net income, as you can say, this is our operating income. After operating income we will be having other interest expense and interest income related stuff. Then we have earning before tax, so EBT we call it. Then we adjust our income tax, then we will get net income. But still after this net tax there may be few line item with regard to non-operating business kind of stuff. Then after all those things will be considered, then you will get your net income. But that is like you have any merger and acquisition, you sold particular branch kind of stuff, so those things will come. Then after finally you will get your net income. So that is why it is saying net income is smaller compared to comprehensive income, because in OCI we will add our OCI, other comprehensive income, whatever plus or minus whatever that would be, then you will get the value that is called a statement of comprehensive income. That is also you need to be clear. Whatever the plus minus adjustment during the period, that will be called as a other comprehensive income. When you club both of them, net income plus OCI, that is called statement of comprehensive. That is also critical. Sometimes you might get MCQ with regard to what is called MCI. They will give you the value for net income 20k. They will give you the OCI is -5, and then as per after adjustment you will have 50. So in MCQ they may ask you what is your OCI, so you might answer this 15. So that may be that is why I'm explaining. When they are asking OCI, you will be giving this value. When they are asking a statement of comprehensive income, then you will give this value. I hope it is clear to you. Key point: comprehensive income, total change in equity from non-owner resource during the period. This is simply meaning these are the thing, dividend and issuing share kind of stuff. Item from income statement like revenue, expense, I already discussed. Item not on the income statement such as unrealized gain and losses. These are the income we cannot put into our income statement because this is not realized. Whatever the asset we have purchased, share or whatever thing we have purchased, and then we have not sold, that is not being earned. Since we have not earned, we cannot recognize here. Revenue and income basically we can recognize only when it is being earned or generated, or only then we can recognize. And expense are recognized based on consumption. If we have consumed those kind of service, or we have taken service, or we have used that product, so this kind of concept will help us to, based on period cost, we can, like interest expense related stuff, we can recognize our expenses. But unrealized gain and losses, these are the loss we cannot book into our income statement because this is not coming based on the IFRS law and GAAP. But the psychology behind it, the concept behind it is not realized. But since share market is going down, so there is prediction they may go down or something, or maybe they will keep it here only, but later on they may go up. But if it was not going down from then, that time what you have purchased, if he has followed the same pattern, not getting up and high, and then if it going high, so then their value would be comparatively higher side, right? Now it is from where we have purchased, now it is going down, so whether we recognize it or we are not recognizing it, but it is a loss. You are getting my point? It is a loss. From here it may go here also, that is another thing. But if we sold at that point, but then time we will recognize the loss, right? We will be losing the money. So that is why they are giving this option, so that you can update into your statement of comprehensive income. That is mostly used in investment banking related company. They are having huge money in the market, so their value and their currency changes related stuff will come, like foreign currency translation. So that time they may have a huge amount compared to other company. Gain and loss from prior service cost, credit related, debt valuation adjustment, it will come later. I will explain you this. To define benefit pension plan not yet recognized, net periodic, like benefit plan we have not yet recognized our income statement as an expense, we have not recognized. Or maybe if IFRS and US GAAP rule are allowing us to book those expense, but take assumption, or if you have hundreds of CR for this pension scheme, you can divide into 10 year or 20 year based on that when you are about to pay. So you can slowly recognize those expenses slowly. Do not need to book all the expenses, then your net income will be gone and you will not generate any profit. So that is how it is working. So that is why these are the things you cannot recognize instantly or immediately, or there is some rule and guidance. Based on this only you can move into your income statement. Unrealized holding gain and loss on AFS, as discussed. Effective portion of gain or loss of cash flow hedge. If you have any cash flow hedging related stuff, you are getting any gain or loss, that those things you cannot mention in your income statement. That is why we need to update into other comprehensive income. These are the things you can read it out. I have just tried it so that you can get better clarification. I think I have explained you everything with regard to comprehensive income. Comprehensive income includes of your other comprehensive income. Other comprehensive income is just changes between two periods with regard to all those 5 transactions which I have mentioned before. And then accumulated comprehensive income is your total changes, net income, then OCI, then comprehensive income. These OCI related changes will go to your accumulated comprehensive income, and net income related changes will go to your return earning into your balance sheet. So these are your balance sheet items, this one also. Now we can see a company named Goldman Sachs. His income statement, as you can see, they have 2022-2023, they are reporting their net revenue is somewhere 62 million or something, whatever it is. Then they have income tax. This is not audited or not final, so that is why their income tax may not be coming. Okay, So this is not our concern. The point here is after income statement, there a statement of comprehensive income is starting, and this is a statement of comprehensive income. This value is called a statement of comprehensive income, and this part is their OCI. So let's see what are the items they have mentioned. They have mentioned debt valuation adjustment. As I was mentioning in the previous slide, there was debt valuation adjustment. So they have mentioned about this, financial reporting, but I have just copied it. The statement of comprehensive income is set of page. This is the page number they are referring, and then company other comprehensive income which relate to company debt valuation. This one related to debt valuation. There was a loss of $434 million, and compared to gain of 1,489 million. That point I have no idea from where it is coming, but this is their net income or something, and from there if they are adjusting their loss, so they are overall their gain. The overall the periodic return is minus 372 million. So if you see this only, whenever you are value the stock price, or and you are trying to understand about marketing kind of market point of view, their share price, stock value, whether to invest or not. So if you see this, you may invest. But if you see this value, will you invest? I don't think anybody will invest if they will see they are going to have a huge loss in future. Okay. What is debt valuation adjustment in OCI? So DVA adjusts the value of company on debt to reflect change in credit risk. Whenever you issue a particular amount to in market, that time they might be issue in 100 million, so the same value will be at that time. After some time, if their value has dropped down to 95 because of credit risk, if credit risk has been improved, in those cases your value will go down. That is why if you will recognize this, so you will have to book 5 million as a loss of your money. That is not our topic right now, otherwise I would have explained this to you in detail. So now we are learning about a statement of comprehensive income, so we should stick to that. And their balance sheet I have just pasted here for the same company, Goldman Sachs. They have accumulated OCI, you can see they are having. So this is just earlier whatever they were having, in that they have adjusted, now it is showing 116. So let me see it from the previous point of view. They are having 434 as a minus 325 minus 434, so 109 it is coming. They are mentioning 16. There is some $7 million differences. So you can see earlier they were having positive accumulated comprehensive income. When they have adjusted 2023 related comprehensive income, then their net figure is coming something else. Okay, you got it. A similar way, when you add 62 in your all return earning, your return earning will increase. So this is how it is actually working. You have seen the proof now. Okay, now reporting point of view, according to accounting standard 220, single continuous statement net income represent the total net income and its component. Other OCI represent total OCI and its component. So both are representing their own component. That is called single continuous statement. When you are reflecting only this, you are not maintaining this, or you are creating single and separate. When you are clubbing together two separate statements, as you can see, as per the reporting comprehensive income according to accounting standard 220, single accounting system, when you are getting single net income, whatever its component, then you are separate, or maybe if you are only considering OCI, then it is OCI and there its component, whatever component they have. When you club together, then two separate statement, when you club together, then it becomes statement of comprehensive income. So total net income and its component, no changes in these two definitions. That's so. And then a statement of comprehensive income immediately follow the net income you have to follow, and then starting net income and show total OCI, then show total OCI and its component. So then it becomes your statement of comprehensive income. I think this is the same thing I have been explaining. Presentation notes, OCI may be shown in the net of tax or not. Either you charge tax, or I mean to say in the statement of OCI, if you are showing net income, then you have OCI. Whatever you are showing value, either it is net of tax or not net of tax. Whatever you are doing, if you are having a net of tax, then you don't need to specifically mention in the disclosure regarding to tax effect. If you are showing without tax and not considering tax, total value if you are considering, then you have to disclose those. So this is the presentation point of view. You have to, how you are going to do, that is being guided by IFRS rule or maybe US GAAP. The same rule, I think it is being followed. Report accumulated OCI income in balance sheet, as I have been telling, accumulated OCI will go to your balance sheet as a part of equity separate from stock and APIC and return earning. Same thing I have already explained. So thanks for watching. See you into the next session. So stay tuned. Thank you very much.